just one look in, you know I'm good to go. You know I'm good to go.
Hello, thank you for joining us on Minds of Commercial Real Estate. Today we have Bryson Blackwell from Wealth Strategies. Hello, Bryson. How are you doing?
Good. How are you?
Good, good. Thank you for joining us on the podcast.
Oh, I'm happy to be here. Yes, I'm happy to give a little intro on myself and tell you guys a little bit about what I do and how I do it, and hopefully provide some value for you, get some insights that you've been looking for. So I've been in the financial services industry for coming up on 4 years now. I've had the pleasure to work with really interesting people and partner with really interesting people, whether it's in the tax world, the investing world, and in real estate overall. But what I specifically do is I help real estate investors pay less in tax, but also help them formulate pretty robust and institutional type investment portfolios and strategies. So a lot of the focus that we have is in the 1031 exchange world. That's where, you own a rental property and own it for many years, or you just recognize a lot of appreciation within a piece of real estate. There's going to be some pretty significant taxes due at the end of that sales cycle whenever you go to sell that property. The 1031 exchange is a tax code that allows you to defer the taxes, all the capital gains taxes. It's not eliminating it, it's deferring it by reinvesting those proceeds into another rental property. So that's a strategy it's pretty well known in the real estate world. But what we do a little bit different is that we also take it a step further and help on the reinvestment side. If investors were looking to go into something more passive, maybe they don't want to buy another rental property, they have to manage and own outright. We have an investment strategy that allows you to still complete the 1031, defer the tax, but go into institutional quality real estate at a cost that is affordable for accredited, investors that are coming out of a real estate sale. So I'm happy to speak more on that and cover, the details of that, see how it may be a play for your investors and the people listening on this podcast.
Sure. So you mentioned, so if a person basically is even doing a 1031 exchange, but they cannot necessarily find a replacement, you would place them in a DST. Can we explain that a little bit further?
Yeah. So the DST is an acronym for a Delaware Statutory Trust. Although it has the name Delaware in there, it has nothing, the properties are not located in Delaware. It's a federal tax code. It was just formed under Delaware law. So just to identify what that actually is. But yeah, that structure, the Delaware Statutory Trust, actually allows you to use 1031 exchange dollars into a real estate fund for looking at it as a high level. Whereas if you read the fine print of 1031 rules, you can't 1031 into a normal, limited partnership real estate type fund. So where that comes into play, to your point, if there's someone who's doing a 1031 exchange, to use round numbers, let's say it's a $1 million property they're selling, they may go out and find an $800,000 property that they absolutely love. It's the perfect fit. It's what they want in their investment portfolio. They go ahead and pull the trigger on that. But what happens in a 1031 is that any proceeds that you don't reinvest will be subject to capital gains taxes, also known as boot. So if an investor doesn't want to pay that boot, i.e. in this situation, it would be a $200,000 figure that would be taxed. A DST comes into play as a really unique opportunity to finish the 1031 because the minimums are roughly about $100,000. And you can kind of piecemeal the investment however you want. So you could use that $200,000 and go purchase a fractional ownership of a DST, which essentially means you're buying a fractional ownership of a commercial asset, whether that's multifamily or industrial or retail or self-storage. And you can now own a small percentage ownership of that property, earn the income that is being derived from that property, but be in a fully passive position and complete the 1031. So it's been a really, really good play for investors that need, maybe a smaller sliver of an investment in a 1031.
Now, what are the minimum timeframes for a DST? Are there a minimum, a maximum? Is it very similar to a syndication on a passive level? Can we go a little bit further into that?
Sure. Yeah. I mean, I'd say that, every deal is created differently, right? There's no such thing as the exact same deal across the board. So, what you'll typically find in the syndication world is that, that 5 to 7 year time frame is kind of where DSTs sit. There are some investment offerings and sponsors out there that look to achieve, closer to a 3 to 5 year hold period. It just depends on their investment philosophy and how they view their real estate that they're purchasing. But I'd say on average, they're about 5 to 7 years. Max hold is typically about 10 years. But we're pretty confident that, most offerings that we work with and operate under are going to fall under that 5 to 7 year time frame.
Let's go through a particular scenario today. For example, I had a call today. I had a client that bought a property for about 1.2 million.
Mhm.
He is selling it for 2.5 million. So he has a capital gains of 1.3 million. They are two partners. Let's say, let's go through two scenarios. First of all, if they find a property that right now for 2 million and they need to use the remaining of the 500,000 to put into a DST, is it the same time frames as that 1031 or is it different? Let's go play that scenario.
Sure. Yeah. So let's just say everything stays the same. They stay as two partners within that LLC or however they own that property. What would essentially happen is they would sell the property. They would set up the 1031 like normal. And at that point, we follow the 1031 timelines and the rules, right? So you're 45 days from the close to identify your replacement properties. After day 45, you have 135 days to close on whatever properties you're purchasing, right? So all in, it's a 6 month period. So if in that scenario they use the 2 million, they purchase a property within that allocated time. At the same time as they're doing the purchase of the first property, we're also going to be talking about DSTs and understanding how much do you want to, invest in a DST, what kind of DST offerings are available and accessible with your given time frame, and how many different investment offerings would you want to go into. So, if it's 500,000, let's say they go into two different DSTs, each at $250,000. The process stays the same under the 1031. It's not going to change, right? There's no separate 1031 you're setting up for that scenario. It's really just another replacement property you're listing under your identification, and you're going to close on it just like you would any other property. So when you're considering multiple options like you're talking about, whether it's pairing a property with a DST, it all is happening at the same time, of understanding your options at that point. So I hope that gives a little more clarity on that situation on how we would approach it, which essentially is we wouldn't necessarily change anything from a process perspective. It's more so DSTs just take a little bit more education for investors that may have not heard of it before. So I always recommend talking about it well before they close so they can plan around it and understand their options earlier than later.
If somebody were to come to you today and say, I have a 1031, what DSTs you have available? What are the top three you would say you have available today?
Yeah, today we've got a handful of different offerings that are available. I'd say we've got probably 30 on our platform that are accessible and available. Between those three, or between all of those, I'd say the three that I'm a big fan of right now, we have a industrial portfolio in Midland, Texas, that is about 29 properties, 29 different tenants. And it's a really unique opportunity because the properties serve the Permian Basin. So all the oil and gas operators out there drilling for oil and gas, they have leases with these buildings to occupy and store all their equipment in these buildings. So it's a very mission critical asset to these different corporations and companies. And Midland, Texas is obviously a huge location for oil and gas operations. So it's a really unique opportunity there. And you have a ton of diversification through the different properties and tenants within it. I'd say another investment opportunity that I really like is it's actually a small portfolio of coffee retail locations in the Southeast that are brand new built, long-term triple net leases. And they're is this an attractive offering based on, the coffee boom, number one, but also the diversification with multiple properties under that DST as well. And I'd say lastly, there's a good multifamily investment opportunity out there that is, Class A, brand new built in Kentucky, and that's another offering that has caught my eye as of late. The numbers look really nice on. So I'd say between those three, that covers industrial. We have a retail in there, a retail asset, and a multifamily asset. So uh, let's go back to your example of a $500,000 investment they're looking at doing. We would look at splitting, and again, this is just a hypothetical, splitting that 500,000 three different ways, evenly across three different asset classes in multiple different markets in different sponsors. And that's kind of how we view DST investing and how the approach is kind of put together.
Sure. Who typically chooses the properties for these DSTs?
So the DST sponsor is who is managing everything from A to Z. So that's going to be the group that's going out and actually doing due diligence on the properties, doing the acquisition, doing the investor relations, putting together the debt, and ultimately managing the asset itself, but also the exit. So the DST sponsor is a core piece of a DST offering. There would be a DST without a sponsor managing it, right? Then it wouldn't be passive. And so they go out and they'll go purchase the properties before they start raising money for a DST offering. So it's not like they're going out and identifying a property, needing to raise the money first before they can actually close on the property. The properties are already closed and titled to the sponsor. Now they're just trading their position out to the investor for DST ownership. And I bring that up because it's really key to understand that, because with 1031 timelines, being able to close within a 6-month period is what rule you have to follow. So the fact that it's already acquired, your equity ownership in a DST is essentially secured to know that you'll be able to close and finish up on the 1031 side. So
Let's go a little bit more in depth, let's say, of those retail coffee shops you were mentioning. If somebody is interested in that, can you give a little bit more of details? Is like who about the sponsor, what kind of management fee they're going to take, percentages, they're giving out. Can we get a little bit more knowledge
sure.
of that?
Yeah. So the sponsor for that specific offering is called Madison Capital Group. They're a multi-billion-dollar real estate developer and asset manager. We do a ton of business with them, not only in DSTs, but a lot of other real estate development and fund strategies that they do. So they predominantly focus in three sectors, which would be multifamily, self-storage, and retail. And the portfolio itself, it's off the top of my head, I believe it's a $25 million portfolio across all the different properties in terms of the value. And, the strategy there is they're going to obviously own the properties. The leases are anywhere from 15 to 20 years. So they're long-term set leases. It's going to be pretty steady throughout the entire lease period. When we're talking about fees, typically with DSTs, there's a few fees that are going to be charged. There's the acquisition fee that the sponsor takes. That's their way of earning their compensation for doing that part. There's going to be some commissions that get paid to advisors like ourselves for bringing the investor to the table or into the deal. And there's going to be some marketing fees to get it marketed and sent out to the public. And then from that, it's pretty much just asset management fees, which are typically 1% to 2% on an annual basis. That's where they typically fall under. And then at the end, when they go to exit, unlike most other real estate fund strategies or syndications, there's no promote, there's no back end split with the sponsor. The only thing the sponsor will take is a disposition fee. And usually there's a threshold that they have to return X amount to the investor before they can even take that disposition fee. It's not always the case, but that's what we look for in our due diligence when looking at these deals. But they'll take a disposition fee, which is anywhere from, call it 2 to 3%. So pretty standard from a real estate perspective of what kind of fees are being charged on that end. And everything else, all appreciation is subject to go to the investors. So, there definitely are some fees involved. Then, that's one of the things we look at as well when doing due diligence. But I'd say that pretty much makes up how the sponsor is charging and creating their revenue stream from these assets.
As a borrower, what would you say what are the main differences between a 1031 and a DST?
As a borrower,
Right. If they're going to choose to do one or the other.
well, the 1031 and DST go hand in hand, right? So the DST is an investment that most investors are 1031ing into. You can invest with cash, but typically because of the way it's structured and the way these the DST, the regulations that they have, I'd say about 90% of the time investors are coming to me looking to invest with $1031. From a borrower's perspective, I'd say one of the unique things about DST strategy is that the debt that may be associated with a property is non-recourse debt. So the debt's not actually going to have any recourse on the investor to go after their personal assets if anything were to ever happen with the property. The sponsor is essentially guaranteeing that debt on their balance sheet. So when an investor is doing a 1031 exchange, one of the rules, well, not necessarily one of the rules, but one of the guidelines you have to follow is that you have to not only replace the equity of whatever you sold, you also have to replace the debt. So that can either be in the form of a new loan, just going out and talking to a lender and getting a loan for a property. You could bring new cash, right? Just subbing out cash for debt, but you can't sub out equity with new debt, right? So it's kind of on the flip side there. So with DSTs, because the debt is already taken out on the property and it's guaranteed by the sponsor and it's already set in place, kind of goes back to what I was saying with the acquisition already being done. When an investor is owning a fractional equity ownership in a DST, if there is debt associated with it, they're also purchasing a fraction of that debt. So we can create new debt for an investor who has debt to replace in a 1031 through a DST without having to go through a lender, without having to personally sign off on that debt, and being underwritten for it. So, and that's where efficiencies are created from a closing perspective because we can get these done in 3-4 days. It's just signing paperwork and transferring funds, and if there's a debt replacement need, it's already done at close. So it's pretty unique and definitely a big value add for some of the investors we come across with high LTVs.
Are there any particular investors that typically always go DSTs? Is there a trend?
Yeah, I would definitely say that the most common investor that I see with DSTs is going to be that the pre-retiree or retired, range in their investing career. Typically looking at that next chapter of life, just wanting to free up more of their time and energy to spend it with family, travel, do whatever is important to them. So, I'd say that 60 and up age range is typically where they're saying, I've been in this real estate game for 20, 30 years. I've built my generational wealth through this. Now it's time to take my foot off the throttle, take a step back, find a way to maintain this wealth, protect this wealth, earn some income in retirement, make sure it gets passed to my family, but not have to answer the phone at 2 a.m. with a leaky toilet or a AC going out in the middle of summer here in Scottsdale, which is a nightmare. But those kind of situations and those kind of clients is where we typically see the most activity. But we've definitely had investors who are younger in their career wanting to just defer tax and have a steady revenue stream. We actually had a couple one time where they were running a successful Airbnb portfolio, probably about 5 to 6 different properties, but because of where interest rates were and how their cash flow was working, they weren't positively cash flowing anything. They were just breaking even and paying their debt down. So fairly newer in their real estate game, but they were selling a property that had some more equity on it. They wanted to free up some of that equity to be more of a steady cash flow stream for them, and so they looked at DSTs as another option within their portfolio. And they were, they were mid 40s, early 40s, so it just depends on the investor situation and what they're looking to achieve and accomplish. It really does range from that point.
Are typically the DSTs mainly commercial properties, or are there sometimes residential properties as well?
Predominantly commercial, but we've had single family rental portfolios, but not to get that construed with, these small, they weren't those portfolios. They're not going out and buying single family homes and putting it under a fund umbrella. They were actually purchasing neighborhoods and communities that were specifically built for rental communities, right? The BFR, built for rent, or single family rental developments that you see out there. They may go out and purchase those kind of assets, but I mean, they're always commercial. Actually, it's almost always commercial. You can make a case that that's residential, but it's multifamily at the end of the day. So it's predominantly commercial.
Okay. If today you have somebody that's just, beginning to learn about DSTs, what do you recommend for them to do?
I recommend to talk to a professional about it. You could do research online, but just like everything else, if it's like when you get sick and you do some research online and it tells you have cancer when really it's a common cold, that tends to be true in the investing world as well, that there's just a lot of misinformation out there. So I'd say if you're considering it, if you have a property that is in your portfolio, or looking at, what's next, how do I, kind of transition from this property into something more passive or something that works better for me, I would find a professional to work with that understands that investment strategy, but also understands 1031 exchange, because that itself is its own science. And, it's their compatible strategy, right? The 1031 is the tax code, the DST is the actual investment. Those are two different things you have to tackle and understand. I would recommend finding the right people to talk to your CPA or accountant, and understanding your personal situation on if it's something that makes sense for you. If you're just looking at DSTs as an investment, you're going to have to work with a representative anyways. So it's definitely worth going out and finding a good relationship to have, which I'm happy to be that for my clients, obviously. So that's what I would say.
If you have one recommendation in regards to DST, what would it be?
Do research, ask questions. There's no such thing as a dumb question. I've had investors that are scared to ask certain questions, but they actually turn out to be some of the best questions that I get, even if they're challenging. But that's important when making big investment decisions and doing due diligence. So I would say, not to be afraid to ask those kind of questions, and just be curious and pay attention and take notes, because if this is the route you're going to go down, chances are you're going to learn a lot and you're going to have a lot of information thrown at you. So just be organized, and, again, just lean on the people around you and the team you build, whether it's real estate agents, financial advisors like myself, CPAs, attorneys. Just really leverage that network that you have as you build your investment portfolio.
Well, thank you, Bryce. And how can the viewers reach you?
A few different ways. I'm very active on LinkedIn. LinkedIn's a big platform that I utilize. It's actually how we met, right? So that's a good way if you ever want to just look at my content. I post regularly on this strategy and other alternative investment strategies and other tax strategies. So feel free to follow me there. You can reach out to me via email at Bryson, BRYSON, at WSAGAZ.com, or you can give me a call at 602-931-7607. Those are all pretty effective ways to reach me. So, yeah.
Well, thank you, Bryson, for being on the show and all the valuable information.
Yeah, thank you for having me. This is a great show. I'm happy and thankful to be contributing to it. So it's been great. Thank you.
Thank you for watching. If you enjoyed this episode, please give us a thumbs up, subscribe, share any questions or comments in the comments below, and follow us on social media. I look forward to seeing you next time.
Let's get together. Let's get to having some fun. Let's do whatever. The night's looking so young. Let's get together. Let's get to having some fun. Let's get together. Let's get together. Let's get together. let's get together.